these currencies, with absolutely nothing to back them, are in a very, very dangerous situation. As soon as the confidence starts going in them, they could easily revert to their true intrinsic value, which is zero.
Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and back with us today is Alasdair MacLeod from GoldMoney.com. Alasdair, thank you so much for joining us today.
Thank you for inviting me, Elijah.
All right, now the first topic I'd like to discuss is the trade war between the U.S. and China. Because last time we had you on, you were saying that really China's trade is starting to dominate the global economy instead of America's trade, and this could have a negative impact on the U.S. dollar because the U.S. dollar is going to be used less and less in world trade. Now, with the trade war kind of heating up right now, how does that impact China's trade?
Well, what I said last time was that America, by taking, if you like, a protectionist approach to her own trade, was really withdrawing from global trade relative to China, whose trade is increasing all the time. We now have this trade war. The thing that sparked it off, in my opinion, was the introduction of the petro-yuan contract on the Shanghai oil exchange, the INE exchange, they call it. And I am aware that before that was introduced, there were negotiations between the Americans and the Chinese because the Americans didn't want to see it. It quite simply undermines the status of the petrodollar. The Chinese, incidentally, have no ambition at all to have a reserve currency in the yuan. What they want to do, basically, is not have all their trade settled through New York, and therefore ultimately the control of American foreign policy. That's where they're coming from, as it were. That has now led to, if you like, a trade war in the sense that intentions to introduce tariffs on aluminium, steel, and then there was a response from the Chinese, and then another response from the Americans, and so on. And the most recent thing is that the Chinese appear to have backed down a little bit. The rationale in that is that the Chinese only import something like $150 billion worth of goods from America, whereas there's a figure like 600 or 700 billion goes into America. So you can see that in a trade war, ultimately, China loses. But I don't think it's quite as simple as that, because there are other elements to this which the Chinese can undertake. And one of them has been suggested in the last few days, and that is that China will stop buying US treasuries. Now, this is very important because President Trump is increasing the pace of treasury issuance through his increased deficit plans in the budget and so on. So we can see there's huge quantities of treasuries going to be issued. If China is not buying them anymore, then that is going to have a very negative impact on US interest rates and bond yields, as it were. So you can see that it's not just that. On another side, I think we should be worried about how things are being geared up between America and Russia through a proxy war in Syria. We have overnight, we had pictures, certainly on our television and I'm sure you've got it in America, of alleged gassing of children and these children being hosed down and all the rest of it. I mean, quite honestly, if you look at that video closely, it's hard to see that there is any real evidence of chlorine gas or whatever. Those children seem to be actually all right. They're just being moved around, pushed around. People are looking in their eyes. People are giving them inhalers. And, I mean, it doesn't look as if they actually need them, and also hosing them down. So it looks like a very dramatic Cecil B. DeMille production, if you like, done on someone's phone. I could be wrong about that, but, that does not constitute evidence that there has been chlorine gas with whatever agents, nerve gas, whatever mixed into it, used in a bombing raid on civilians. Yet, at the same time, we seem to have this attack against Russia in particular, starting with the Skripal case in Salisbury, in this country, where we very quickly came to the conclusion that the only people who could have done it was the Russian state. Again, this is, if you like, guilty by association, perhaps. They had tried it before with Litvinenko. They actually killed him. This is going to be an interesting one because the Skripals survived it. Yulia is now out of hospital and now in a safe house. Her father is recovering. Now, I don't know that the news reports haven't said whether he's conscious or not, but he's certainly out off the critical list and recovering rapidly. Now, the whole point about assassinating someone like him is that you assassinate him if he's got something to talk about and you don't want it to get out into the public domain. That being the case, it's failed. So I await with great interest to hear what Mr. Skripal has got to say about why he was targeted. That actually could change the whole complexion of the thing. Yet here we are, before we even get any evidence of what's going on with Skripal, who actually did it and all the rest of it. We're now going full pelt into what appears to be a proxy war against Russia. This is very, very dangerous, I must say. We've already seen the price of oil yo-yoing a bit. It's up a bit today. The story is that Saudi Arabia want to try and get oil up to $80 a barrel so that they can do their IPO on Saudi Aramco. I don't know if that's the case. That sounds a bit far-fetched to me. I think more likely, here we are going to war, in effect, against the largest oil exporter in the world. There's so many sort of mishaps, it looks to me, on the international trade front. So the whole situation is not clear. It is dangerous. And I think we just have to literally take it day by day.
Now, dangerous, you say, in what way?
Well, dangerous in the sense that the Americans are trying to provoke a military conflict, if you like. The Russians actually have some very high technology. I don't know if you recall, but it was only about a month ago that they announced that they had a missile that travels at Mach 20 and in effect is impossible to shoot down. This could, just push the bear a bit too hard, and this could turn nasty. The Russians, I don't think, actually want to go down that route. Primarily, my reading of the Russians is that they want to protect their borders. They're not interested in having a war against America. What they are interested in is America trying to attack their borders, hence Ukraine. And the movement of missiles towards the Russian border, allegedly pointing at, I can't remember who was pointing at, I think it was Iran, wasn't it? This was 10, 15 years ago. The Russians reckoned that there was absolutely no reason for those missiles to be put so close to the Russian border. If you wanted to attack Iran, then you have a NATO ally called Turkey, and you can put all your missiles there. So, there is this distrust that's been built up, and I have to say that a lot of it has been on the American side, threatening the integrity of Russia's borders. Russia, I think, has got other responses. Her currency has been very badly hit by this. The Russians are not responding to that as yet. The stock market there has been hit very badly. That doesn't really upset Putin and the rest of them. I just wonder, they can have a response. I'm just sort of thinking that it's quite possible they could push up the price of gold, which would undermine the situation in the West, because the whole of the basis of Western currencies is that gold is no longer within the system, and there is nothing, if you like, to expose them as fraudulent, in the sense that this is just government currency, which is completely worthless. So, there are other things that can be done. I think we've got a financial war, potentially. That's been going on for some time. We've now got the potential of a military conflict. I see there are reports that the Chinese warships that are in the Mediterranean, not that I was aware there were any in the Mediterranean, they have been instructed to join the Russian warships in the Mediterranean. It's worrying times.
So in what way do you think this could impact, getting back to, for example, if you think China is planning to buy less treasuries, how would this impact the U.S. dollar?
Well, it would impact the US dollar because obviously if they're going to buy treasuries, they buy dollars in order to do it. And traditionally what they have done is they've suppressed their own currency by selling yuan for dollars. So there will be, if you like, a negative effect on the dollar. And we've already seen the dollar has tended to weaken, and that's got more to do with the euro today. But I think the main thing is that if they do stop buying treasuries, then as soon as that is confirmed, I think you'll find that treasury yields will start rising quite sharply. And that, of course, will have the effect of undermining the equity market. We've already entered into a bear market on US Treasury bonds. I think it was back in June 2016 was the bottom. So we've been going for over a year now, over 18 months, almost 2 years, into a bear market for US Treasuries. Equities have continued to perform fairly well against a background of rising bond yields, but only to the extent that the rises in bond yields have been very limited. In November, if you look at what happened to the 10-year and the 30-year treasuries, the yields started rising quite sharply last November, and that was the beginning of undermining the performance, the bull market, if you like, in equities. So my view on this is that if we get a further rise in US Treasury bond yields, then I think that will definitely tip US equities into a bear market.
It seems like, we're seeing a correction, obviously, right now. You're saying that it's probably going to tip into a bear market soon then?
Yes, I think so. And what's interesting is that it's the equity markets until fairly recently were very stable. They sort of were just gradually inching up the whole time with very, very little correction. And now you've definitely got volatility. I mean, when you have 1,000-point swings on the Dow, I know at 24,000 it's not a huge deal, 1,000 points, not like it was back in 1987. But nonetheless, this is a very differently performing market. And on that basis, I think, yes, we look as if we are at a turning point in that market. I don't see it just being a consolidation, a correction. I think that we are due to have a really thumping great bear market in equities. Now, the reason I say this is that President Trump is stimulating the economy at completely the wrong time of the cycle. He is going to require the Fed, in effect, to print more money, get the banks to print more money to buy US Treasury debt. And unless the foreigners are in line with this, equally soaking up this debt, there's only one thing can happen, and that is that the bond yields, US Treasury bond yields, are going to rise and rise sharply. That will kill the equity market. Not only that, but we will then see that all this extra money going into the US economy will drive up prices, because extra money, no more supply of product, and particularly if you have got tariffs imposed on imports, prices are going to rise. Prices rise, interest rates have to rise. So you can see that we're going to get into a sort of almost a stagflationary cycle, exacerbated by this stimulus at completely the wrong time in the credit cycle. And if we get interest rates rising by very much in the United States, then it is quite simple. We have got a credit crisis around the corner, and I think that credit crisis is likely to happen at the end of this year or in the first half of 2019 at the latest. And this one, the one that's coming up because of the increased quantity of debt in the global system, I think this one is going to make the great financial crisis of 10 years ago look like child's play.
Now, speaking of the last financial crisis, if you look at the stock market, specifically the Dow, it went, the percentage decrease, if we saw that same percentage decrease today, the Dow would be around, it would fall to about 12,500 approximately. If you're thinking it's worse, it's going to be worse than that. Would you put your target on the Dow below that 12,500?
Well, bear in mind that I don't actually analyze the Dow, but all I can say is that if you go on history, I suspect that the movement in the Dow could be a replication of what happened in 1929 to 32. And in that case, they lost over 80%. I'm not making that as a forecast, but I think that it's indicative of the sort of danger that equity markets find themselves in, because they're going from a valuation where interest rates are zero to a valuation where interest rates are having to try and discount rising price inflation. And that's a very, very different scenario. And the relationship with markets towards the end of, if you like, a recovery come growth phase before the financial crisis is bonds peak first, equities peak second, and then you get the crisis. And I see nothing to change that order in current circumstances.
Right. No, we've had a prediction of 3,000 Dow. You're at 80% down would be about. It would be just about above 5,000. So definitely within.
Could be more. It could be less.
Yeah,
I mean,
definitely.
One variable in this is that if the purchasing power of the dollar starts collapsing, which is quite possible, because what the Fed will do, their response to any credit crisis is to throw money at it. They will throw money at it. The foreigners are up to their necks in dollars already. I calculate they've got about $17.8 trillion worth of investments currently. So all those dollars, I mean, it comes to 95% virtually of your GDP. I mean, this is absolutely enormous to have so much of your own currency in foreigners' hands is a very dangerous situation. The dollar actually could collapse. If that happened, then what do? You get out of the dollar and you buy anything not to own dollars. And at that point, perhaps equity markets will take off. And, I mean, it's then, 20, 30, 40, 50 on the Dow. But that doesn't mean to say that equities have gone up. It means that the dollar has gone down.
Right.
And the only hedge in these circumstances is to have gold. And with everything that's going on the international scene and the complete lack of response in precious metals markets, which I can understand, because I think we're rather like rabbits frozen in the headlights of an oncoming car. I think that gold could actually pick up quite rapidly, and if it breaks through that 1400 level, you won't see it for dust after that.
Right, wasn't it during the German hyperinflation when the stock market just took off, but if you actually measured the value of it, you were crushed, basically, even though it was, 1,000% or whatever above where it was before. The value of it was way, way down.
And the same was true with Zimbabwe, if we look at a more recent episode. And there you quite clearly saw that the only way that anyone could avoid the collapsing currency was to buy shares, which is what they did. And hence, in theory, the best performing stock market in the world for a while. But I mean, as you rightly say, measured in dollars, which is really, if you like, the only alternative that was available in the black market, it was down hard. So inflation does these things, I'm afraid. And the way to look at it is we're looking at a situation where potentially the purchasing power of the dollar could take a very, very big hit.
Now, you recently wrote an article regarding this topic about the collapse of the dollar and how this is inevitable, you say. I just want to read a quote from the article. You said that all other fiat currencies take their value from the dollar, not gold. So the destabilizing forces on the dollar really could take down the whole fiat complex as well.
Yes, that's what I would say to that. In that article, I drew attention to two previous episodes where the dollar had really suffered. The first was in the wake of the Wall Street crash. The dollar suffered. It didn't appear to suffer because obviously you had a gold standard. And in many cases, it was morphing into something called a gold exchange standard. So really what you were seeing were prices measured in gold were falling sharply in the Depression. And that was corrected to a degree when Roosevelt devalued the dollar and moved the price of gold measured in dollars up from $20.67 to $35 an ounce. So that was, if you like, the response to the situation that had developed over the 1920s, and particularly the late 1920s. It led to a substantial quantity of dollars in foreign ownership. Now, the reason for that was that America was helping Europe recover after the First World War. And it did this on what we would call a gold exchange standard. In other words, dollars were being lent to Germany and France in particular, and we were lending sterling to them as well. But what happens with the dollars is they don't go out to Germany and France. What happens is that they stay in the US market because that is where dollars are invested and spent. What it does is, obviously, it means that the Bank of France's balance sheet looks better because it has got quasi-gold in the form of dollars added into its balance sheet, which it allows it to raise funds or to produce extra currency for its own domestic economy. So that is the way in which this gold exchange standard worked. And it meant that both Germany and France, between 1926 and 1932, accumulated substantial quantities of gold by redeeming those dollars back into gold. That was the first episode of it, and that was one of the factors that led to the devaluation of the dollar in 1934. The second episode was in the mid to late 1960s when the gold pool, London gold pool, was operating, and that was operating to give the Americans, if you like, a little more help from the Europeans in terms of keeping the price at $35 an ounce. But again, France and Germany had accumulated an awful lot of dollars. In this case, the dollars had been accumulated firstly through gold exchange standards under Bretton Woods, and also by the, if you like, off-balance sheet creation of dollars to finance first the Korean War and then the Vietnam War. So you had huge quantities of dollars which had accumulated in foreign hands. And it came back via France and Germany, and they started redeeming their dollars for gold. So, and that led to the collapse of the gold pool in 1971. The collapse of the gold pool and also the collapse of the Bretton Woods system in 1971. This time we have the same situation. Too many dollars in foreign ownership. And they're all invested in America. And what happens when these guys decide that they don't want any dollars anymore? What happens is that they start selling them down for their own currencies most of the time. And we can already see that, if you have your assets in euros, you're doing a hell of a lot better than having your assets in dollars, because the euro's gone up something like 20% against the dollar in recent years. Even in Chinese yuan last year, that went up 9%. So, who the hell wants to have assets invested in dollars? And you can see that the situation is being eroded, and sooner or later, you're going to get a flood of dollars being sent back home, metaphorically, because they're already in your economy. But they're going to come out of foreign ownership. It means that they will sell dollars, they will drive the dollar down. It's exactly the same situation as under the first gold exchange standard back in the late 20s, the second one in the 1960s into early 1970s. But this time there's no gold. So it's not a question of just regularizing the exchange rate between the dollar and gold. The whole of the fiat currency complex being tied to the dollar is at risk this time. And the consequences of this, we just cannot guess at the moment. But we can see that from a point of view of pure monetary theory, and I talk Austrian monetary theory, not Keynesian monetary theory, that these currencies, with absolutely nothing to back them, are in a very, very dangerous situation. As soon as the confidence starts going in them, they could easily revert to their true intrinsic value, which is zero.
All right. Well, Alasdair MacLeod, thank you so much for joining us today. Before we let you go, did you want to share with the viewers any last thoughts you had and where they can find you online?
Well, I think a lot of your viewers probably know my views already, but you can find me on Gold Money. That's goldmoney.com. And if you go to the home page and you click on the research button, I write an insight article once a week, and that is released on Thursday afternoon Eastern time. And I also do a market report the following day on the Friday ahead of the weekend, and that again is released Friday afternoon Eastern time.
All right. Thank you so much, Alasdair.
That's my pleasure.